Hello, and thanks for joining us today. My name is Dave Sukert. I'm a Senior Vice President with Aon, the endorsed administrator of the AICPA's member insurance programs. Through the course of the afternoon, I'll be joined by my colleague, Stan Sterna. Stan is the Vice President here at Aon and heads up our risk control for the AICPA's professional liability program. And we'll also be joined by Sarah Ferentz. Sarah is the head of risk control for the AICPA professional liability program, and she's with CNA. On behalf of Stan and Sarah, I'd like to sincerely thank Tom Hood and the Maryland Society for this great opportunity to discuss some of the risk issues that are affecting us all in this new COVID reality. While there are many issues to talk about out there, we've decided to pick three. The three that we want to talk about are the employee and criminal theft, the use of e-signatures, and firm management liability. So Stan, why don't we just hop into the employee and criminal theft discussion? And as I thought about this, I thought about a quote that probably a lot of us have heard, that desperate times sometimes call for desperate measures. I'm not sure if these are desperate times, but they're certainly strange and unprecedented. As we talk about theft today, I'm thinking about kind of two different types of people: those that have that are purposefully nefarious in what they're doing, and others that are just maybe driven to do things that they wouldn't otherwise do. And today, one of the things that we're really talking about is stealing. So we always try to use numbers to put some focus on a topic. So maybe we can share some of those numbers around what the losses statistics have actually been.
Yeah, Dave, and like you said, that is one of the best ways to kind of get a perspective about a risk, is to take a look at these numbers. And internal control weaknesses are responsible for nearly half of all fraud claims. And that's kind of an obvious. You're certainly much more target, and you basically are going to be a prime target if you have weak internal control. So no, double review of signatures on checks, or what checks are going out in terms of client money to pay bills, if that's what your engagement calls for. So in most of the claims that we see, or at least half, these type of fraud claims by employees, kind of the loss driver, as I like to call it, is this internal control weakness. And when I say loss driver, I mean systemic issues, long-term historical systemic issues at a firm that creates a breeding ground for a certain type of claim. And in this situation, we're talking about employee theft. As you can see in the second bullet point, the cost of an employee theft claim can be quite substantial, $130,000. That's not as big as maybe the average attest failure claim that a professional liability claim that a CPA firm may see, but it is a substantially large amount at issue, and it's larger than the most frequent type of claim in terms of average cost, which is tax, where you got a finite amount of money usually at issue, either through late payment penalties, or if the tax was incurred because of faulty advice you gave, it may be at issue. There might be some negotiable interest that's at issue. The average cost of an employee claim could be as much as what's money's currently available, or assets are currently available that can be taken, and how greedy and how the individual, the perpetrator, is, and how weak the internal controls are. 22% of that number of employee theft claims can cost more than $1 million. That's a staggering number when you think about it. And we're going to talk a little later about some of the issues you may find with your current professional liability policy that may preclude any sort of coverage for employee theft. So when you're talking about numbers of this magnitude at the percentage that we're talking about, it's a substantial exposure. Cyber attacks again, through when you're dealing with employees that are using ways to infiltrate systems or get around data security, steal is another important issue. 43% of cyber attacks will target organizations with less than 100 employees. So you may have a situation where you're dealing with a small firm. Again, this is could be an employee working in cahoots with a hacker. It can be maybe a situation where somebody is just duped by the hacker. But in the smaller firms, sometimes the smaller firms, it's reflective maybe of the good nature of the employee relationship, management-employee relationship. People know each other. Usually the duration of how long they stay at those firms are longer. So you have much more of, I guess, going back to what you said, Dave, that trust issue with the smaller firms that can really create, a breeding ground for theft. 91% of these attacks are by sophisticated cyber criminals, and they go through email. And generally, what it is a cyber criminal will use some sort of ruse in order to target an employee who, maybe they have infiltrated the email system. They're aware that this particular employee is responsible for paying maybe client expenses or handling client funds or assets in such a way, or has access to client proprietary information. One of the majority is through this email compromise, some sort of business compromised email that will try to trigger somebody to transfer money out of a firm fund that they use in order to deposit and maintain client funds. 16 months is the average duration of a fraud scheme. Not too much higher than maybe the average for many claims, but 16 months can be, pretty daunting in terms of, this can go on for many, many months, and somebody might not be aware of it. And a lot of what's done in terms of just scamming by these cyber hackers goes under the radar. And, when you're dealing with this, maybe you're going through 16 months also a forensic study trying to figure out what's going wrong, that has a major impact on you doing business and you servicing your clients. So another important factor to consider with these type of clients.
It's kind of the same discussion that we always have, and I would hope practitioners would have as they sit back and look at this and think, wow, could I handle that? Could my firm handle that? Could my partners handle that? Is that something we're equipped for or ready to deal with? I don't know if anybody is, but again, putting numbers around an issue tends to drive focus. So if that wasn't enough, as we move to the next slide, if it wasn't enough to put numbers on it, maybe we could talk about some real life examples. And I kind of call these the there, but for the grace of God, go I examples, because I'm sure that every one of them, everyone that listens to or reads these examples could identify, not that it has happened to them, but that they could put themselves in the place of the folks that had to endure these three examples. So Stan, maybe we talk a little bit about these.
Yeah, Dave. And again, just from, speaking about these type of incidents and claims, not these type, but any type of risk or claim scenario involving, when you're practicing and when you hang out your shingle and you bring in clients in, nothing resonates more, I think, to underscore the risk than hearing about real life claim examples. And these are based on real life claim examples. So, in the first bullet point, we have a senior engagement partner at a CPA firm is providing payroll processing services, a common service that many CPAs, I'm sure, listening, provide for their clients. Over time, that particular employee had access to substantial client funds and stole $500,000 from multiple clients over several years. And they were doing this through the creation of ghost employees. Theft ended up being revealed. And when the client noted that there was an unusual name on their payroll. Again, in that particular situation, we had access to a large amount of client funds. We had somebody that had developed trust with multiple clients, and there was opportunity. The next claim scenario is somewhat different. It's a wire transfer issue, another common claim scenario. A CPA firm made a wire transfers amounting to $2.5 million in response to email requests that appeared from a high-profile client, when in reality it was a criminal that had taken control of the email account. Again, a common claim scenario. It's an email, business email fraud, and usually the pattern is, again, somebody has hacked into the email account. It could be as real as that. It doesn't have to be one with multiple misspellings or from an address that maybe looks like your client's address but isn't. It could be as insidious as an actual email saying basically, I need, we're having, some urgent cash issue, or we need something in order to close some sort of transaction or deal. Can you transfer this amount? They will usually pattern those emails off of previous emails that the individual partner or employee at the firm may have received. And if you have access to those funds, a lot of times the funds will be distributed in some sort of account that's being maintained by the client, by the accounting firm itself. We have seen, unfortunately, many situations, including this one, where a substantial amount of money has been transferred from an account on a bogus email simply because somebody maybe didn't follow up and make a phone call to the individual or send their own email to the address they have to the individual with a follow-up call saying, is this accurate? There's a lot of money being asked to be transferred. I want to make sure it's accurate. The third bullet point is where a CPA firm associate brought a friend, a wealthy elderly woman to the firm in order to do money management and bill paying service. Again, another common family office type of service arrangement. That particular associate proceeded to write unauthorized checks for his own personal expenses and bonuses totaling nearly $1 million. In effect, in this particular claim situation, he took advantage of the opportunity that he had of being not only a trusted advisor in the vein of being an accountant and providing services to a client, but being a trusted friend or family friend of this individual, this elderly woman, took advantage of her infirmities and as a result stole from her. And she ended up passing away, and it wasn't until the heirs of her estate, after her demise, discovered that there was a substantial amount at issue. So these were three type of different scenarios that I called through the list of some of the scenarios that we've had with years to kind of give people a flavor of the different type of employee thefts that we're talking about in this particular presentation.
So we kind of talked about numbers and actual real life examples. Let's talk a little bit about kind of the world we're living in right now, right? We talked about living in this new COVID reality. I have to feel that's changed and heightened kind of the risk for this kind of a scenario.
Yeah, David, if we could switch to the next slide, please. Yeah, I mean, obviously it does. I mean, the major impact that, COVID's going to impact a lot of how we do things. Obviously, it's changing, the way that accountants are working remotely. It's changing how the office will be set up in a post-COVID world in terms of workplace safety. But the major impact in terms of just analyzing its effect on claims is the economic downturn. The pandemic has created economic upheaval. When there is economic upheaval, we see an increase in claim, and not only in terms of frequency, that means the volume of claims that are coming in, but also severity. And that means the amount of money that we're paying, both in claim expense costs and indemnity, meaning settlement or awards, it could be jury or arbitration awards that are being paid. So when the economy goes down, historically, there's a bump in claim activity and severity. And it's no clearer in terms of how prevalent that is until you look at the increase in failure to detect defalcation claims, whether that's failure to detect defalcation or embezzlement by maybe a client, like an embezzlement, or excuse me, like in an audit where somebody alleges that you failed to detect embezzlement, or an employee who has access to client funds and is stealing money that way. Why? There's a couple of reasons that I can see with the impact of COVID-19 and the economic downturn. As we talked about, you have increase now. You have an increase in remote client accounting services. So you're having clients are asking you, meaning the CPAs, to provide more of the accounting, the general accounting work that maybe they used to do in the past. And we used to help them with, but not so much serve as kind of a quasi CFO role. That's changed. It's changed a lot even before COVID because of the development of client portals. But even now, it's changed. People are concentrating on creating new revenue streams for their business. People are some companies or clients are wondering not only about creating new revenue streams, but how to stay in business. How to maintain client base. They're doing things that streamline their own organizational structure by possibly laying off or furloughing employees or redesignated staffing. All this creates a new work structure, work environment that could exasperate and enhance the opportunity to steal from clients. By employees or through fraudulent instructions from cyber criminals. Why? Because chaos breeds opportunity for individuals, nefarious individuals. For the reasons I stated, it can have a significant impact, staffing and work remote issues on internal controls. Other less experienced people at your firm may be the ones who are now taking over internal controls about monitoring requests for payment from funds, or maybe internal controls for flagging potentially harmful or fictitious email requests for money. The situation also impacts the fraud triangle. You have now more opportunity and rationalization by nefarious characters to steal money. I've seen, I've been doing this a long time, and in the past, when we've had economic upheaval, one of the things that drove some of these employee or mostly the employee embezzlements, weren't just somebody's greedy all the time or somebody is just a bad person. It's sometimes the impact they're feeling from external forces by the economy on their own personal and financial life, that if they have the opportunity and the rationalization to steal money, they do it, because sometimes desperate times create desperate people. I've had claims in the past where the reason an employee stole client funds, I had one particular one where a woman, her son had a health issue and she was having trouble paying medical bills. And, she was desperate, and that was one reason why she was enticed to do it. And there's no excuse for that kind of conduct. But again, times of desperation, times where difficult times financially, it create that opportunity and that rationalization to steal. And that's unfortunate, but that's something that we've seen historically in the past, and we expect to see it again in the future, given the current state of the economy.
So as we move to the next slide, let's talk a little bit about just kind of the relevance of all of this to CPA firms. Obviously, we just gave some pretty stark real life examples of CPA firms that have been stung by employee theft or by cyber criminals. But let's talk a little bit about the relevance to CPA firms themselves.
Yeah, I mean, obviously, you have the specter of potential criminal exposure. So, you certainly don't want to have a situation where, a member of your firm is being investigated by the local authorities, for all the reasons why that is not a good situation. And I think that it leads to the very next bullet point is reputational harm. I'm sure everybody out there listening today has spent a lot of time and have devoted a lot of resources to protecting the reputation. I mean, any licensed professional, that's really kind of the biggest asset they have. And you've spent so much time building relationships with your clients, building relationships in the community, maybe building relationships with an alliance that you're a part of, or your local state CPA society, and one incident from a rogue employee that you weren't suspecting any sort of nefarious conduct can ruin that. It can ruin that goodwill, and that's significant because no matter you can minimize the loss, you can mitigate the loss. There could be a restitution order where the thief is going to pay back, even with interest, the sums that were stolen. But it's not going to. That reputational harm is always going to be an issue. And if you're a smaller firm or you're a small community in a small community, it can have a devastating impact on your practice. There's also the specter for potential punitive or exemplary damages. You certainly don't want to be in a situation where you're sued civilly for some sort of conversion of assets by one of your employees, and as part of that, they're alleging some sort of punitive or reckless conduct that maybe pursuant to the law of your particular jurisdiction will put you in the crosshairs of a potential punitive or exemplary damage claim. I think one good example is if you're serving in a trustee capacity, your firm, and you have a fiduciary duty to maintain that trust assets, and a rogue employee with access has depleted some of those assets. Fiduciary standard is going to bring you to a higher degree of scrutiny, which is going to increase your chances of such exemplary or punitive or multiplied damages. So then you're then turning an award that maybe has a finite amount at issue, which would be maybe the loss of the funds, to substantially more damages because of the exemplary or multiplied portions of a damage award. And then you have the potential for professional liability coverage issues. And this is something I mentioned earlier. There is a fraud exclusion in most professional liability policies that say if there is an award for fraud or intentional misconduct, such as a conversion of assets or a fraudulent scheme to convert assets, there's going to be a coverage issue. You may not have coverage. Same thing with a property exclusion. A lot of policies will say, if it's a situation where you lose client documents that are in your possession because you need them, because that's the services you provide, you need those documents, or filings or paperwork, that's one thing. But if you're converting tangible property of the client in some way, shape, or form, like money or assets, and converting them to your own personal use, there is no coverage for that. So you can face another coverage issue on a professional liability policy if one of your employees committed theft. The last one is prior knowledge. A lot of policies will say if you had any knowledge of a claim or the potential that there's a reasonable basis for a claim to arise from certain circumstances, coverage could be precluded. There is case law out there that will say that if you have an employee who was stealing from a client and that those acts existed, predated the policy inception, those acts, that person knew that their acts would be subject to a claim. And that knowledge can be, not all the time, there might be some carve-outs, can be imputed to the firm as a whole. And the firm could lose coverage based on prior knowledge. So those are, I think, pretty compelling reasons why a CPA should care about this particular subject.
So, so now that we've alarmed everybody, or at least brought their attention to the subject, how do we help them? Because that's what we're really trying to do. So, from a risk standpoint, maybe we could talk about how can we help people and help them help themselves from a risk standpoint with regard to theft.
So, yeah, good question, Dave. So, what are the risk management tips? What kind of things that can firms do to avoid this issue? Well, obviously perform background checks on your firm employees, especially those with access to the firm or client funds. You want to make sure that you're putting people in a position that you feel comfortable with. And you certainly, not everybody, unfortunately people go through, through life. There can be situations where they've had an issue in the past. There might not even be a criminal issue. It could be just maybe, somebody is, for want of a better example, maybe going through a divorce, and it's a costly divorce, and money is tight. Or in one claim scenario I had where a woman working at a firm had a son who had a drug habit, and I don't know if she was necessarily feeding his drug habit, but trying to he owed money to different individuals and was giving him money in order to pay these individuals because of drugs. And as unfortunate of a situation as that is, in both situations, the firm said, I had no idea. I didn't really do any background check. I didn't talk to them. I didn't really have a feel for the individual and what they were going through. I didn't know so-and-so was in some such financial trouble because of the divorce. I did not know that my other employee had these issues with her son. It could be as simple as just, kind of just not prying into anybody's personal life, but just generally knowing, what is their current financial and even mental health well-being at the time. Some firms will do actual background checks, whether it's criminal or credit background check, to kind of get a feel for what that person's past experience and past history has been, and then make decisions accordingly as to whether or not they should have access to funds. Obviously, you need to establish a clear segregation of duties and other internal controls with handling cash by the firm. Unfortunately, I have seen a lot of firms where one individual is put in a position, that person receives the invoices, if they're paying client bills, reviews the invoice, then has access themselves to the checkbook, writes the checks themselves, and sends the checks out. There is nobody who is double checking the invoice and making sure that it's an accurate invoice for services or goods that has to be paid on behalf of the client. Nobody is looking at getting access, maybe having access to the check register in some sort of secured system, whether if you're using paper checks, having them under lock and key, whether you're using some sort of electronic deposit, having multi-authentication security, or having another person have to provide access. No segregation of duties, and no one else kind of monitor the situation. Maybe check sign off, having sign off by somebody else, or somebody checking in and approving the sign off of a check. All those things seem very commonplace, but unfortunately it goes back to that trust issue we talked about. Sometimes you have that trust, that unmitigated, unsuspicious type of trust you have for an individual. You're never going to question their motives because you think they're the salt of the earth, and for whatever reason they may be, but they may be going through some of the personal or financial issues I talked about that make them desperate in a situation. Again, we're desperate times sometimes make people react in ways that they wouldn't. We talked about the 2 or 3 factor review and authorization of client payments. And I like to have required, or I think it's best practice that requires some level of client involvement. So review and approve disbursements, approval of new pays, additional approval of disbursement that exceed a specific threshold. Have procedures in place so that if you get an email from the CEO of a business client of yours that is saying, I need you to transfer $2 million to somebody, you're going to make sure that you're going to go back to that individual and confirm that transaction. You may want to put a threshold, an agreement with the client that each transaction over a certain amount, $5,000, some minimal amount, is going to go back, and we're going to get approval from you with regard to the amounts, that it's going to an accurate payee, that these are accurate distributions. So I think that's very important to get the client buy-in and confirmation. In the engagement letter, document responsibilities of the client, the responsibilities I'm talking about. And, make sure that they know what their duties are. If you're performing client accounting services that include paying expenses, that their duty is, whatever those duties are in order to create this internal control structure in their own confirmation. Again, validate all client wire transfer requests. I suggest, just make a telephone call and, verify the client number and then follow up with an email. So there's documentation saying, hey, as you know, we talked about this request for a wire transfer. You confirm that it's okay via the phone, just confirming an email. I'm going to be issuing the wire transfer at the end of close of business today or tomorrow. If this is inaccurate in any way, please advise. And then if you have any insufficient fund issues with the client, immediately contact them to discuss it with them and in writing. That goes without saying, but you want to be especially sure if you're somebody at the firm who is in charge for maintaining internal controls and you see there's an issue with insufficient funds, when your firm is controlling disbursement of those funds, you want to make sure that maybe, if the person handling those for your firm says, well, it's an issue with the client, that it is indeed an issue with the client, that there is not an insufficient fund issue just because, unfortunately, an employee is maybe using those funds for their own personal use and depleting them accordingly.
So Stan, as I listen as you talk about risk, I kind of equate risk to prevention. Not foolproof, but at least give you some tools to hopefully prevent a problem. And 3 words kind of resonated with me as I was listening. Vigilance, oversight, and maybe even a healthy bit of professional skepticism. And I know that may kind of run counter to the whole trust thing we've been talking about. I don't think so. I think it confirms it. So those kind of things are just really doing your job and making sure you're taking care of looking out for the potential risk that's out there. So,
one thing I would add is, I know you're talking, trust is important with your client, but I think that kind of underscores the trust factor with your client and kind of enhances that. I think most clients appreciate that you're going to be diligent following up with them and making sure that large threshold disbursements are confirmed by them and that they're accurate so that you don't put them in a bad position.
Exactly. So we talked about risk a little bit. Then we can talk about coverage a little bit. We've been talking about how a firm or an individual can protect themselves against theft. And I kind of, like I said, the risk I equate to prevention, not foolproof, but prevention. And the coverage I equate to protection. So maybe we can talk about that on the next slide a little bit, just about some of the risk transfer vehicles you might want to consider.
Yeah. Again, coverage is important. And there's a lot of different products out there that could, give you, I guess, peace of mind. And so that if unfortunately this happens, because even the best prepared firms, the more diligent firms, unfortunately, sometimes a bad apple, or not even a bad apple, but just a desperate person is employed and is put in a position where they're enticed to commit theft for one reason or another. So, crime coverage generally applies to the loss of or damage to certain types of property resulting from, and we'll go through it, employee theft, which we talked about. It's another type of wrongful act that it will provide coverage for is forgery and alteration, whether that's forging the name on a check or doing anything else that's underhanded or maybe dishonest in order to create an alteration or a forgery that will benefit them personally. Computer fraud, we talked about that. Fraudulent instructions that directs a financial institution to transfer, pay, or deliver money or securities from a firm transfer account. Again, some firms have funds that they maintain. The firm maintains client funds that they're used in order to pay client money, client bills. We've seen time and time again instructions that appear to come from the client saying, pay this money. And again, being duped into doing that because they were actually fraudulent email instructions. Social engineering kind of goes hand in hand with the previous bullet point. Again, firm employee being misled through some sort of communication by a party who fraudulently purports to be a member. It can be an employee of the firm. It can be a client or a vendor. It can be anyone. Those are the usual means of deception that generally a crime coverage will provide insurance for.
E-signatures, social distancing, remote workplace. We're not in front of people like the way we normally are. We're doing things remotely. We can't get wet signatures. So e-signatures are becoming more and more necessary. So Stan, I know we talked about it at our last quarterly meeting with AICPA. This was a topic of discussion for probably a good half an hour. So maybe let's talk a little bit about the e-signatures, some of the rules and regulations behind it, and some of the things to think about as it becomes more and more enforced.
Sure, Dave. Let me just give a quick overview of the laws that govern e-signatures. First, you have the U.S. Electronic Signatures and Global National Commerce, or what is commonly called as the e-Sign Act. That's a federal law that governs the use of e-signatures in interstate commerce. It recognizes electronic signatures and e-records of parties to a contract as legally binding. Next, you have the Uniform Electronic Transaction Act, or the UETA, and that governs other type of transactions. It's a uniform code that governs the use of electronic signatures in ordinary business. When I said other types of transactions, I mean those in ordinary business rather than interstate commerce. The UETA recognizes electronic signatures to be legally binding as well. And it has been adopted by 47 states in one fashion or the other. Certain states have changed some of the requirements, but the UET as a whole has been adopted in the vast majority of states. Meanwhile, the IRS has publication 1345, and this is going to be on a resource page that we provide at the end of the session. 1345 provides specific guidance for e-filing of certain individual tax returns. You should note that while not all IRS forms may be signed electronically, the IRS announced just last week, August 28th, that it would allow the temporary use of digital signatures on certain tax forms that previously could not be filed electronically. This IRS exemption to the wet signature requirement only lasts through December 31st of this year. So we also provide some resource information on the August 28th announcement. In any event, both the e-Sign Act and the UETA generally take the same approach towards establishing the validity of e-signature usage in business. First, the parties must intend, and I would suggest that this be in writing, to sign and consent to do business electronically. Next, the parties must keep a written record that reflects the process by which the electronic signature was created and generate a graphic or textual statement which is added to the signed record proving that the signature was executed with an electronic signature.
Note that depending on its use or the involved industry, federal and state regulations and laws may also impose additional requirements in addition to what I've just talked about. So you should check those out. You might want to consult with your counsel as well before embarking on using electronic signatures. Next, I would suggest that to avoid any misunderstanding that the parties are consenting to do business electronically, you consider including language in your written engagement letter that notes that the parties are intending to use electronic signatures. And we, again, provided some sample language that you may want to consider. Again, any written agreement that you decide to put together, you might want to consult with your legal counsel as well. But this gives you an idea as to the type of language that we suggest and be included in the engagement letter to get the agreement of the parties to electronically do business.
Great, thanks, Dan. So one other issue around the e-signatures, a lot of firms, CPAs use vendors like PandaDoc, DocuSign, et cetera, third parties for ease of process. Any advice around using third-party vendors in this venue?
Sure, Dave. Like when you use any other vendor, you need to vet them. So you need to do your due diligence. Don't just look at price. I suggest you look at some of these following factors. Obviously, the financial viability of the vendor. You want to assess whether the software that the vendor is using is both intuitive and easy for you to use. You also want to look to make sure that the vendor's software can be fully integrated with your current IT systems and your internal control procedures. You want to determine if the vendor has a strong emphasis on IT security, and you also want to evaluate their existing safety and security protocols. Finally, and I think this is very important, you need to confirm that the vendor's service agreement with you contains the following. One, a provision requiring them to maintain cyber and other applicable insurance coverage throughout the engagement and for a period of time thereafter in the event of a breach or an error in omission in the performance of their services. I'd also suggest, two, a provision wherein the vendor will agree to defend and indemnify your firm in the event of any third-party claims because of their negligence, and negligence in providing the platform that is used for electronic signature.
Today, we wanted to address an issue that you might not have spent too much time thinking about. Specifically, we want to talk about management liability. And over the next 20 minutes or so, we really want to cover 4 or 5 different things. First, without any further ado, Sarah, why don't we get into the first slide, and maybe you can put a little bit of framework around what management liability isn't.
When CPAs think about risk, they often think about the risk that arises through the delivery of services to their clients. Whether it's preparing a tax return or performing an audit, that's professional liability risk, not management liability risk. And CPAs, due to their skills and expertise, are often asked to sit on boards of directors or other governance committees of various organizations, perhaps a school or a not-for-profit entity. That's management liability risk, but not the management liability risk that we're talking about today. Finally, CPAs sometimes serve in trustee roles. Sometimes it's for a client's employee benefit plan or even a client's personal trust. Those roles also carry a fiduciary responsibility similar to those acting in a director or officer role, but we're not talking about the risks related to acting as a trustee today.
What is it? What are we really talking about when we're talking about management liability in this context, Sarah?
Right. Well, we're really talking about the risk that arises due to the day-to-day management and operation of the firm. That's the management liability that we're talking about today. So the actions of any individual that serves in a management capacity of a firm can give rise to management liability risk. Those individuals might include whether it's maybe it's the partners or shareholders of a firm, depending on the firm's entity type, the officers or directors, such as the CFO or the leaders of individual offices or areas of practice, perhaps. Or maybe your firm is of such a size that the partnership agreement calls for an executive committee to manage the day-to-day operations of the firm. And really, it's anyone that serves in the management role can give rise to management liability risk. And why is this important? Well, not only can the firm be held liable for management liability claims, Individuals that act in a management capacity can also be personally liable for claims related to things like mismanagement of the firm or breach of fiduciary duty. And so I think that's important to understand, the kind of risk that we're talking about today.
Wow, that really jumps out. So I guess as I sit and listen and think about the things you just talked about, I heard the word firm quite a bit. Management of the firm, not so much how we deal with clients. That's a different thing that we've talked about in the past and we'll continue to talk about. But it's about the firm and firm management. Something that really jumps out to me is what you just said. If I'm a partner in a firm or someone that is in management, I can be held personally liable in that capacity. That's going to get my attention, and it clearly has. So as I listen, I kind of sit back and think about, all right, if I'm someone that is management at a firm or could be perceived to be management of a firm, this is certainly getting my attention because I could be someone that could be in the sights for a management liability claim. So why don't we roll on to the next slide and talk a little bit about what some of the risk is and who could actually bring a claim.
Right. So in professional liability claims, we see assertions being made against a firm, by various parties, not just the client. So it could be lenders or creditors or investors or, so on and so forth. And similarly, management liability claims can be made against the firm's management by a number of parties, whether it's independent contractors or a vendor or creditor, or perhaps it's the firm's current or former owners, or even competitors of the firm, which I thought was an interesting twist.
Yeah, that is interesting. So when you think about, usually we're so focused on client as we should be, but this kind of gets you to start looking maybe beyond that a little bit and at everybody that you work with, everybody that you come in contact with, and this slide kind of depicts that. So appreciate that. So Sarah, thanks so much for the insights on kind of what this isn't, what it is, and kind of what the risks start to be. Again, hopefully people are starting to think about their own experience and where they are in their firms and how this may affect them. So Stan, as we move on to the next slide, maybe it's a good idea sometimes to utilize some statistics and numbers to kind of frame what we're actually talking about.
Yeah, Dave, and I always find that's one of the best ways to gain, perspective and insight as to the risk, looking at the statistics, just like anything else. So on this particular slide, we see the first bullet, and the average cost of a management liability claim is $394,000. That's the average cost. And that's comparable to some of the high-end exposures that we see for professional liability claims versus CPAs. Also note on this slide that within a 3-year period, 26% of private companies will have experienced some sort of management liability-related loss. And that threat is especially relevant with early-stage startup businesses. I would note that we should expect more management liability exposures because of the downturn of the economy as a result of the pandemic. And we'll get into that in a little bit more detail shortly, but suffice it to say that historically, a bad economy equals more claims in terms of frequency and more severe claims. As for common management liability claim scenarios, 54% of management liability claims lawsuits were by clients or investors. And let me give you an example or a few examples. An investor sues a company executive for breach of fiduciary duty claiming business mismanagement. Another example would be a customer or client alleging a pattern of misconduct that your executive board or executive committee failed to detect. Note that in the next bullet, that's 37% of reported suits were from vendors or suppliers. A good example of those type of claims is when a vendor or a supplier is suing for breach of contract, maybe for unpaid fees, or tortious interference with a contract. 27% of reported suits or fines were by governmental agencies or regulators, such as the SEC. And 27%, as Sarah noted, it was from competitors. And, what type of allegations can competitors have? It's usually allegations that aggressive postures or business moves by the board resulted in a restraint on trade. And then 23% finally are just the simple ones. Well, I don't want to call them simple, but they're by a partner or an officer of the company, such as a company executive asserting that he or she was wrongfully terminated or let go due to actions by other executives. So This slide kind of gives you kind of a flavor of the type of claim scenarios and the cost of management liability exposures.
As we move to the next slide, we talked about these stats that are up here now are just kind of general stats, but the next one, we should, we're talking to CPAs. Why should a CPA care? So maybe we can talk about how this, how we see this kind of impacting potentially the accountant's world.
Yeah, Dave. Well, first, 96% of businesses that experienced a management liability claim indicated that it caused financial damage to the business. And, unless you are extricated from a lawsuit early with minimal claim expense, you're going to feel a significant financial hit. But also note in this slide that 42% said that the claim resulted in a loss of business productivity. So, and you could just imagine if key personnel at your firm are stuck sitting for depositions, reviewing and producing documents in response to discovery requests, attending mediations and court proceedings, and generally immersed in the stress of civil litigation, it's obviously going to have a major impact on productivity at a firm. Additionally, 36% said being embroiled in one of these suits had a negative effect on the morale of the business. And, consider the morale of non-management employees wondering about the status and state as well as the integrity of the firm that they work for, as well as the status of their individual employment when management is embroiled in a nasty management liability claim. You can see the impact that it has on company and in this case firm morale. And then finally, this slide notes that 31% said being involved in one of these claims negatively impacted the firm or the company's brand or reputation. And Dave, nothing hurts a firm's brand or reputation more than being involved in protracted publicly filed litigation that alleges that the company either mismanaged its affairs or performed some sort of misconduct. And that's regardless of the truth of those allegations, unfortunately. Your brand is what's really important to you, and you obviously spend a lot of time strengthening that brand and maintaining that brand. And something as simple as unfortunately, a lawsuit, even those allegations may have doubtful truthfulness or veracity, can cause irreparable harm to that reputation and brand.
I remember my dad always telling me that trust and reputation are earned in drops and lost in buckets. And this is your life's work, right? You, your partners, your team members, your family, everybody has spent years cultivating that brand reputation, that face to the public. And something like this could really tarnish that. And sometimes there's no coming back from that. So of all these things, they are all very important. Boy, that last one really hits home with me, and I assume it does with the folks that are listening as well. So let's move forward a little bit and talk about, we're in the kind of COVID atmosphere. I'm not sure when we're going to get out, but clearly this risk has always existed. Stan, maybe we can talk a little bit about kind of how COVID and the way we're living now and dealing with things now, whether it's changed it. Has it exacerbated this potential risk for firms and practitioners?
Yeah, Dave. COVID has impacted, obviously, not only our day-to-day lives, but, from my perspective as a risk control consultant, it's affected all kinds of different types of claim exposures, and in particular management liability. Especially because of the impact the pandemic has had on the economy. As I previously noted, a bad economy equals more claims and more severe claims. When times are bad, revenue is tight at firms. People are forced to take more aggressive business decisions and postures. And sometimes those aggressive moves can be considered a restraint on trade, or they can give rise to allegations of negligence or business mismanagement, especially when there is some sort of net loss. During tough economic times, firms and companies will make drastic staffing or strategic changes that may ultimately adversely impact maybe things such as partner key performance indicators, the management structure of a firm, compensation, etc. And some people or many people will take exception to these decisions, especially if they feel that it's adversely affected, either their compensation or what they feel was their path to success at the firm. So another issue when it comes to having the impact of the pandemic is firms are deciding to consolidate with other firms through, mergers or acquisitions. That happens all the time previously, but it's more prevalent when you're trying to pull resources because you're trying to weather an economic storm. Often such transactions in times of economic upheaval are done in haste, or they're not very well planned, and this can result in a variety of allegations, such as inaccurate disclosures during the sale or purchase of a firm, mismanagement of the consolidation due to a lack of adequate integration, a failure to consummate the deal, resulting in some perceived loss, or just a general allegation that the failure or the consolidation failed to produce a promised result that was expected. Also, Dave, financial issues can increase pressure on deferred compensation retirement plans. For example, there may be an increase of claims due to all or part of a lump sum payment owed to a retiring employee not being paid at a specific date. And there is also the specter of claims alleging poor business contingency planning as a result of the pandemic. And, I'll give you some examples: a lack of employee communication about changes at the firm or changes in the way they're going to manage the workforce, or manage client relationships. It could be allegations of a poor system backup or lack of capable VPN availability in order to accommodate a work-at-home environment, or just a general inadequate implementation of a remote workforce or a remote work environment. So you can really see how, in this specific segment, management liability, COVID-19, and especially its impact on not only changes in workplace safety, but also the economy and the economic impact, can really be directly correlated with the increase of exposure of these claims. I think it's important with any risk, Dave, is to understand what it is and understand how your management responsibilities may impact that exposure. And one of the first things that I suggest, and I think it's a good idea, is you should consult with your legal counsel and consider defining in your operating agreement those management responsibilities and what titles or defined roles will have those responsibilities. By doing that, you're limiting the scope of people that could be potentially exposed to a management liability claim. And you might want to limit it to defined roles or titles within the firm, such as duly elected directors or officers, trustees, partners, equity partners, shareholders, or members of the executive committee. It can even be employees that are specifically working as managers at your firm and that have management responsibilities. But the thing, again, is to define what those titles are and what those responsibilities are, so there is no confusion. With COVID, obviously, maintaining a safe work environment has become an even greater concern for firm management. So, now know how to create and maintain safe work conditions in accordance with federal, state, local mandates and guidelines. We have a lot of resources that we've put together since COVID was sprung on us in March, and on workplace safety. And if you're interested, anybody listening, if they're interested in receiving any of those materials, please let us know in the chat room, and we'll be glad to provide you with those materials. I also suggest that firms stay up to date on changes to federal, state, and local regulations regarding things such as changes in filing deadlines. loan relief or assistance, health mandates, lockdowns, etc. It's going to be very important because things are evolving all the time to stay abreast of how things are changing and what's being and how you could make sure that you're in accordance and complying with those changes. Another thing I suggest is document and communicate management decisions. And be sure to regularly review those management decisions. You don't want some sort of stagnant or boilerplate language that you can't evolve or adapt. Again, we're an evolving and environment right now, and you're going to have to be adaptable. So regularly review the documented decisions that you're making. Another thing is, maintaining privacy is always important. And we all know that CPAs have a duty under the standards to protect client confidentiality. But today, more than ever, firms are gaining access to private health information of not only their employees, but, possibly guests to their office. I mean, some firms are taking temperatures as people enter the building, having employees conduct health self-assessments. There's contact tracing. Maintaining this type of information also increases your risk. So make sure that private health data is secure just as much as you're securing client information about financial information or proprietary information. And finally, consider obtaining management liability coverage that will help protect firm assets from management liability claims, but also help protect both firm and its managers, the firm and its managers as defined in the operating agreement, against legal liabilities and statutory obligations. And that coverage should really provide for the defense of both the firm and its individual managers.